Sometimes, as part of the estate planning process, it's the case that shares of stock in a corporation might be transferred by gift. Now, if that happens, you run the risk that the transfer of the shares may be disregarded under Code Section 2036B. That code section tests whether the grantor or donor has retained voting rights at the time of death. The standard is if 20% or more of the retained voting power is deemed to be held by the donor or grantor, then the transfer of stock is ignored. Not only that, this isn't just a transfer on paper. There's numerous attribution rules that can apply through both the grantor trust rules and through Code Section 318. This can be avoided with a bona fide sale of stock, but a gift to a trust of assets which are then used to acquire the stock may not meet this exception. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 186, we're going to look briefly at a grantor's power to vote stock that's been transferred to a trust under Code Section 2036B. Although this doesn't have to be limited to a trust, this could be limited to any situation in which any stock has been gifted away during a decedent's life, but at death, the decedent is deemed to have retained any sort of voting power. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you would like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to our presentation. In previous episodes, we've talked about Code Section 2036. This is a section of the tax code that applies in determining what assets are included in the gross estate. That's the tax base to which the estate tax is applied. So, in other words, what this gets to is that certain transfers during life may be disregarded, and those assets that were previously transferred may be treated as if they're still owned by the grantor for estate tax purposes or the donor for estate tax purposes if that individual decedent has retained certain powers. And one of those powers that's often misunderstood is the power to vote stock in a corporation. Now, we're only really concerned with stock that's been gifted away during life, and we'll get into what that means, but this is often misapplied by practitioners two ways. One is maybe overcaution, and then on the other side of the token, maybe lack of attention to detail. This is one of those code sections where there's many layers to it, and it's really hard to do them full justice. So I'm going to attempt to kind of break this down into steps, but all those steps could fail depending on where we end up with. So it's important to look at any sort of stock ownership and stock transfer situation to see if this could rear its ugly head. Now, what we're going to do is we're going to look at this in the trust context with some exceptions and assume that we have a trust that owns voting stock in a C corporation or S corporation, and then also dig into the attribution rules. So first, you need to determine with respect to that transfer, does another code section override? So before you even get to 2036B, you need to make sure that no other code section would bring all the trust assets back into the gross estate. So generally where this is going to apply is if you have a revocable trust or if you have an irrevocable trust that's an incomplete gift trust. In any sort of those situations, the assets are already included in the gross estate, so you don't even get into this voting right analysis. Now, one big gray area with that is a situation where you have an irrevocable trust that is a complete gift trust, but the grantor is a trustee or could be a deemed trustee. So what I mean here is if you have an irrevocable trust that's funded by gift, and that gift is shares of corporate voting stock, you need to look at whether the grantor is a trustee or could be trustee of that trust. So the weight of authority here suggests that there's no issue under 2036 in general or 2038 if the distribution power of the grantor as trustee is limited by an ascertainable standard. But even if you can escape that, the grantor as trustee may end up having the power to vote corporate stock, which would end run any sort of situation where maybe you limit the grantor's distribution rights or distribution authority to try to avoid 2036A2 or 2038A. Now, really what this gets to is that in any sort of situation where there's a gift of corporate stock to a trust, it's not a good idea for the grantor to be trustee. And even if the grantor isn't the trustee, you need to also dig into the removal powers under the trust. Because if the grantor has the power to remove a trustee and name a successor trustee who is related or subordinate to the grantor, then the grantor could be a deemed trustee in that scenario. And really what this gets to is that regardless of what limitations might be placed on the grantor's authority as trustee to make distributions, the voting rights of the stock still could get attributed to the grantor here. So if you have a grantor who is trustee or deemed trustee, you likely have a problem, and we'll go later on in the next steps to look at the analysis of how much control is retained. Now, even if you don't have a grantor who's trustee, you have to look at whether the trust is a grantor trust, because if it is, then there's attribution of the stock to the grantor under both Code Section 318 and under the general grantor trust rules as well, if the grantor is trustee. Now, in any sort of situation here, even though the grantor is not the owner of the stock on paper, it's these grantor trust rules that deem the grantor to have retained voting powers. And this could apply through multiple layers. It could be that the grantor maybe has the substitution power to substitute assets in the trust with the grantor's own assets, and that could be used to reacquire the corporate stock. And in that situation, it's assumed that the grantor would do so and could get back that voting right. So we're assuming that the grantor is not trustee if we test this, but we still have to dig into that piece because that substitution power in and of itself could attribute voting power back to the grantor. So when we're looking at this too, we have to look at the terms of the trust, and oftentimes it's good drafting to say that the substitution power can't be used to reacquire voting stock. Now, you also have to look at whether voting stock could be attributed to the trust, and even though attribution under Code Section 318 to an entity is only one way, you can't reattribute it back out to other stakeholders, this could be an issue if the trust is a grantor trust, or if the grantor is a trustee or a deemed trustee. Because if the trust doesn't own any voting stock directly, it could be deemed to own it if, for example, you have a beneficiary who has a grantor trust power under Code Section 678, such as a right of withdrawal. If there's a partnership or another corporation owned by the trust, then you can have attribution of voting stock through those entities to the trust. And, as is often the case with corporations, there might be a buy-sell agreement which creates a purchase option that the trust might hold, which could attribute stock back to that back to that trust as well. And that could be significant, one, from the perspective of voting rights attributed to the grantor, and two, meeting a certain voting power threshold that we're going to look at in a second. And with that being said, you also need to take into account any stock outside of the trust to see if it could be attributed back to the grantor or donor. That could be the case if, for example, you have family members who own stock, because you could have attribution once from them to the decedent whose estate we're looking at. And you could have stock that's also deemed to be owned by family members, maybe through an option such as under a buy-sell agreement, which could also create further attribution back. Now, once all this is done, you need to look at a whole and see how much voting power could be attributed back to the grantor. In other words, how many shares are deemed to be owned by the grantor or donor in this case. And if that sum gives 20% or more of the voting power by class of stock to the grantor, then the grantor will be treated as if they're the owner of any previously gifted shares, and those prior gifts will be disregarded. So what will happen is that the growth and value of those previously gifted shares will get pulled back into the gross estate and will be subject to estate tax. Now, before we get there, we also need to look at, is there another exception? because this only applies to prior gifts of corporate stock and not to sales of the stock. But it's important to note that, for example, if you gift cash to a trust, then that cash is used to purchase the stock. That would be treated as a gift of the stock. And that could be an issue, for example, with a sale to a defective grantor trust, because at least for the down payment portion, you could have attribution back to the grantor. You also need to note that Code Section 2036 tests the retention of voting rights both at the time of transfer and at the time of death. There is really no corollary to this under 2038. So it may be the case that if the grantor doesn't have voting rights to begin with at the time of the gift, but picks them up later, that may not always be an issue. But it's also important to note that if you have voting power that's released within 3 years of death, if you have the opposite where the grantor has the voting rights at the time of gift and later gets rid of them, then any release that happens within 3 years of death will be disregarded by the IRS under Code Section 2035. Now, lots of layers to this, lots of complexity. It's hard to really fully wrap your head around this, but hopefully this gives you some boxes to check if you're analyzing an estate for voting rights. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.